So in some ways, I wish you guys could be standing where I am and looking out, because last week was the Miramar Air Show, and I could just imagine these guys sitting here just watching the Blue Angels
through there,
just swoop right through there. I saw it from my office across the freeway, but here you're almost at airplane level.
Yeah,
they're over on the 9th floor up here.
Feels like we're arm distance to the Miramar base right now.
I know.
When they fly, for sure.
Which is actually a good segue into this topic, which is VA buyers. Here in San Diego, we have a lot of veterans, and the scenario I always like to say is they've gotten stationed here, and maybe this is their last station. They're like, okay, this is the last, and then we go home, and then they live here for 2 years, and then they go, why do we want to go home?
Why do we want to go back?
We don't want to leave this. I've just learned how to surf. I've just, whatever those things are. So we have a huge base of veteran borrowers here. And so you're going to be working with these folks. Now, I'll tell you, there are times that it's easier and times that it's harder for a VA buyer to get attention in the market. We've had a few years where it was very difficult. Now it's becoming much better. And the VA program, back from when I was taking this class 40 years ago, has changed tremendously. And so Garrett, let's say that, okay, so you're working with a nice couple. He's a captain in the Marine Corps or something like that, high enough that we're going to have some money to work with, but he could be a gunnery sergeant or something like that. And they say, I want to use my VA loan. So in addition to everything that we covered in the how do you qualify for a loan section, how do you qualify and what's kind of different about a VA loan, both on property and on the borrower?
Yeah.
What makes somebody eligible for a VA loan?
Yeah, great question. So VA is, let's just start off by saying VA loans, if you can qualify for a VA loan and you're eligible to receive a VA loan and you have entitlement for it, it's the #1 loan program in the mortgage industry. It has an interest rate that's 0.5% better than the normal market typically, and you have the ability of putting 0% down and still getting that better interest rate. And your FICO score is capped technically at 620 in FICO score or greater. You'll receive the exact same interest rate on a VA loan. So if you have a 620 or higher, you will get the same interest rate as if you have 620 and some other veteran has 800, you will receive the exact same type of loan program because that's what the VA is guaranteeing for you. So the first things we check, let's say Kevin Wright brings me a VA client. What first we're going to check, right? Whether they're active duty or a veteran, we would go into the VA portal and we would verify their certificate of eligibility. So a lot of us are licensed to be able to verify all of the different certifications of eligibility for veterans and active duty, meaning are you exempt from the VA funding fee? Because the VA, the Veterans Administration, does have a fee to utilize their loan program. But because their interest rate is so much lower, it makes sense for you to pay that fee. And that fee is baked into your loan program, meaning you can roll that cost into your loan program. That 1% or maybe 2% cost to you can be rolled into your loan program. No other loan program allows you to roll in that cost, and we can because this is a government loan. So the first thing we check is that...
Real quick note, the government's not making the loan, and so that's the key thing. They're guaranteeing the loan, but they're not making it. So they're not coming out of the Veterans Administration's budget.
Correct. So they're just guaranteeing that we have followed the guideline for it, and if for any reason it defaulted, they would be the ones responsible for paying back that loan program to the bank. But yes, so it is the lender or the investor's funds that are still providing that loan, but we're doing it to the government's guidelines and their regulation. So if, let's say we have a VA buyer, they come to us, you're using the example that they're active duty, right? So he's probably an E5 or E6 if he's a captain.
Captain would be an O.
Oh yeah, not enlisted, officer. So let's say he's an O5, right? Captain O5. What we would be using in income is everything that he receives or she receives. So if she or he is receiving BAH, which is your housing administration, your BAS, which is your rations, right? And then you have your basic pay. Those are the three types of veteran income, or I'm sorry, active duty income that we see on an LES, which is their form of a pay stub.
It's called leave and earnings statement is what it stands for, but it makes it real transparent to the lender. This is what this soldier or this Marine makes.
Correct, and
Exactly.
they typically pay in forms of months, so it's very easy to consistently see. Hey, previous month this LES looks exactly identical to this LES, and an LES, remember, is just a pay stub or leave and earnings statement. So if let's say that active duty person, let's say he also works on a submarine, or maybe he has special forces pay, or maybe he has flight pay, you'll see a little line item underneath the three basics, which are the basic pay, which is your regular salary, your BAS, which is your rations, and your BAH, which is your housing payment. Then there might be like a special forces pay that we've seen, or a air flight pay, or a submarine pay, meaning they probably are specializing in some type of field for the Navy or the military, and we can absolutely use that as long as we've shown on VA that they've earned that for a consistency of 6 months typically.
Okay,
if
good.
they've earned that specialty pay for 6 months, we can typically say, hey, and ask through questions, are you going to continue this? Is this like part of your current job program with your CO or your commanding officer? And if they say yes, we typically can use that special income. But so that VA income is very important because we can identify, hey, how much are you currently making consistently over a period of time? And does that meet the current debt that you are having right now, which is your credit card debt, your auto loan debt, your personal loans, student loans, whatever it might be, plus the new housing payment that we would be giving you on this property? If your income on that debt to income ratio can be below, typically the VA lets you go higher, about 55% debt to income ratio, even sometimes 59, because a lot of the pay for a veteran is non-taxable.
Right.
So the BAH and the BAS is not taxed on them. Only their basic pay is.
In the old days, we used to call this grossing it up.
Correct.
Because they're working with a net number, so and everything's figured off a gross, so we got to treat a net number, gross it up to as if it was gross.
Correct. And a BAH in San Diego, on a captain, most likely is around 3,000 or something higher than that in that amount. And typically, right, let's say someone was earning 3,000 just at working at Qualcomm. Well, they're only going to see about 1,500 of that typically.
Right.
The active duty person is going to get all 300 or all 3,000 of that. So
Yeah.
that's the difference of why your debt to income ratio can actually go a little higher than just a normal borrower's debt to income ratio. And good news in San Diego is the BAH here in San Diego, it looks like is going up next year by about $800 for housing. And that's because we saw an increase in the housing appreciation, the last 2 years. So if you are active duty, your BAH is absolutely going to be going up next year by about $800 here in San Diego on all different ranks. So we take that income and then we do the normal qualification for a borrower. Hey, do they meet the current debt to income ratio qualifications? Is their credit good above that 620 mark?
Good enough.
Good enough. If they're at 620 or higher, boom, you can absolutely get a VA loan. If you're at 599, you can still get a VA loan, but you're not going to like the interest rate probably as much as if you had a 620 FICO score, because after 620 is where the lenders saw a lot more defaults in the market back in the day, or foreclosures, because let's say, for example, you have a 740 FICO score person, they typically know how to manage their debt, or at least they've shown the credit bureaus that they know how to manage their debt better than a person with a 599 FICO score. So what the banks have done, right, is put in a risk factor or increased your interest rate because your FICO score isn't as good. And that's just a risk mitigation that all lenders do. And that stops right at 620. So if you can get to 620 and then from there, boom, up, you're the best VA loan program available. So that's the same thing with credit. So we'll start verifying the credit, make sure they can qualify. And then the best kicker on the VA loan is the assets, right? The VA guarantees that you will pay back this loan, because if you don't, and let's say you did unfortunately have to get out and sell the property, or you couldn't and you had a short sale or foreclose, the VA, the Veterans Administration, is going to pay back the lender, Cross Country Mortgage or Bank of America, whoever it is that gave that loan, and we'll pay them back because the VA guarantees you that the loan will be paid back on your behalf. Now that doesn't mean you're off the hook. You still defaulted, and the VA is not going to let you get another VA loan until you've paid the VA back.
Right.
But then you're going to pay the bank back right away, and that's why banks and lenders really like giving VA loans away. It's because, hey, we know typically VA buyers too are the best because they've gone through that military regiment. They know exactly how much they make. They're actually the best qualified and typically are the ones that never default because they have that great mindset of always being on time, always making their payment. So we never really see that big of an issue, and that's why the VA is okay with guaranteeing that they'll pay back all loans for any person that gives a VA loan out or any lender that does. And so assets, why is that important to know that piece right there? Is because you're allowed to come into this loan with this much money. And technically, there's a way to even structure it because this is the down payment that you'd have to make is zero. There's about, let's say in typical in San Diego, you have about $10,000 worth of closing costs. There's even a way for the lender to be able to provide that $10,000 in closing costs to you by taking maybe a slightly higher rate than that would be given. We can give you $10,000, so then you really came out of pocket zero. Down payment was zero and closing costs were zero. Or there's sometimes an environment in this market where we put the down payment zero. Let's say we can receive a $10,000 credit from the seller, and we would get a $10,000 credit from the seller of the property, and we can use that to pay for your closing costs, and then you came out of the transaction with literally zero money out of your own pocket to purchase the property. And that's what's allowed for the VA. And there is no benefit to lower or to increasing the down payment except for one tiny thing. It doesn't increase or it doesn't improve your interest rate. But what it can do, going from 0%, if you do have the funding fee, going from 0% to 5% will reduce the funding fee by a point roughly. And then going from 5% to 10% will reduce it by about another half a point on the initial investment up front from the VA. And then once you get past that 10%, it's the exact same. It's about a 1.15 VA fee if you're not exempt from it. But if you're a veteran and you've been discharged with 10% or more disability rating by the VA, you have been exempt from this VA funding fee, and you'll never pay the VA funding fee in your entire life on a VA loan. Whether it's a refinance or a purchase, you'll never have to make that payment if you're discharged honorably with a disability rating of 10% or more.
Yep.
You're exempt from that VA funding fee.
So a couple things. First of all, what he's just describing, we used to call, and probably still call, a VA no-no. So if you hear the term, I want a VA no-no, back in the day, when I was the young guy in the industry, VA no-nos meant that the seller was going to pay the closing costs and the vet was coming in with no down payment. And back in those days, they weren't, we've really evolved into a much better environment where the interest rate floats to the market, and there's not the obligatory cost to the seller to come in with 2, 4, 6 discount points to make the loan happen. So you may have sellers that go, I don't want a VA loan, those are difficult, oh, those are expensive. So you need to learn this well enough so you can counsel your sellers to go, no, it's not a bad thing. And remember, looking at someone, you're not going to necessarily know they have a 10% disability. My good friend Michael, he's a Kaiser doc, a retired Kaiser doc, and he just bought a house with his VA, and but he has hearing loss, greater than 10%, and so that was it. So it's a service-related injury that so there's that.
Yeah, and like you said, back in the day, right? Everyone was afraid of the VA loans for a couple reasons like that, for the cost of getting into the VA loan, and some people were afraid of VA appraisers not being able to appraise the property the same way a private loan or a bank would appraise that property, because the VA, right, is the one that's going to appraise it. There's a little different process with that, and that just means the VA is going to be the one signing off that the property meets the value for the bank. Now, back in the day, it was that VA appraisers weren't valuing the property nearly to the degree of an appraiser on a private mortgage or private loan. And the reason for it was because we didn't have the same practices of underwriting standards and guidelines and regulations. Right after the crash in 2008, all guidelines, regulations, and the way that you appraise, all banks have to conform to the government's rules and regulations. And so every appraisal from that point moving forward, typically you would start seeing that they would all get in line. And about now, we're 12 years later, 14 years later from the crash, we're seeing that the VA appraisal is identical to a jumbo appraisal, or the VA appraisal is identical to a conforming appraisal, because we all follow the same rules and regulations now that the government has set a standard for. So that fear should be squashed right away. If you ever hear that in the marketplace, that, oh, I don't want to select a VA buyer because they'll never get to the value of the home that we've agreed to, wrong. All appraisers now are using the exact same rules, regulations, and guidelines, and we will meet that same value on a VA appraisal just as much as a jumbo appraisal. So that's a big one. And then, yeah, same thing. The cost of doing a VA loan over time has come down so much because of the market rate that the buyer's getting. It doesn't cost you nearly as much on your investment to be able to cover that closing cost. And because the VA is giving you that guarantee that they can put zero down, the VA, the veteran or the active duty buyer is getting a massive benefit because, one, they're gonna get a better interest rate. They come out of pocket with zero. Their appraisal is now meet and matched all the other types of appraisals in the marketplace. So if you have eligibility to buy a VA loan, you absolutely want to help a borrower or a veteran or an active duty person get a VA loan. It's the best one out there.
So just go a little deep on terms. So the VA loan has a different name. It's called a CRV, Certificate of Reasonable Value. So that's why sometimes it's a little bit different. Probably less so now, but back in the day, again, appraisers were also deeper in the home inspection. They would gig you for different property conditions more so than a conventional appraisal. I don't think we see that as much.
Nope. There's like a couple things to it. The government appraisals, like they really are tight on lead and paint peeling and termites. Those are like the three things that we see the most on government appraisals that are different than, say, conforming, but they all have to meet a health and safety standard that is the exact same health and safety standard across all appraisers.
The other thing we used to have is that it used to be that the vet could not pay for anything. That's why we had to come up with these. They couldn't even bring in their escrow fee even if they had it and wanted to pay for it. Now they can. Now the vet can actually pay for the termite if they want to, and that was never allowed before. So they've loosened it up, and they've because it was too onerous, it was too tough on the veteran. They were missing out on things. So this makes the veteran a lot more competitive. Quick note on the veteran, as I understand it, yes, they can be active duty, but they will have to have re-upped once. So they have to be a veteran. They have to. So if you're in your first 4 years, you're not going to get a VA loan. You have to, re-up, and then you can get your certificate of eligibility. Is that still the case?
No.
I'm wrong again.
Yeah, no. Now it's changing just slightly because we're always in a position of, technically we were in a time of war at that period of time, and so typically. Previous to where we were as when we got, I think it was out of Afghanistan, we were considered no more in war.
Okay.
Right before that period of time, as long as you served for 4 months with the VA in a time of war, you were eligible for a VA loan.
There you go. See, these things are changing. That's why I just go talk to Garrett.
And like I said, we have 20, we're in San Diego, right? So we have a lot of active duty and veteran clients. And our population is made up of about 25% veterans. So a VA appraiser is also most likely appraising jumbo loan products, also appraising conforming loan products. And so our community of appraisers all know exactly where other appraisers have appraised homes, and they're probably doing it for a bunch of different loan programs because San Diego sees a good distribution of all different types of loan programs. So when you do a VA appraisal here in San Diego, you're going to get the same value that you would do it on a more conforming or traditional mortgage product.
Okay, let's talk about, so obviously you got a veteran and they have a spouse.
Yep.
We can use the spouse's income, right?
Yep, absolutely.
So I have a veteran and he lives with his girlfriend. Can we use the girlfriend's
income? Absolutely, if they want to put 12.5% down on a down payment. You got to be married on the VA in order to be able to put 0% down.
Okay.
If you want to bring your girlfriend onto the loan or your boyfriend onto the loan to help qualify, let's say to get the bigger home or because we need more income to meet the monthly payment, to meet that debt to income ratio to qualify. Well, then because the VA guarantees you that 0% down option, well, now we cut that in half. And in half for us, that 20, I could go into this very deep, so I won't. But in essence, if you bring on a non-borrowing spouse on the VA loan, then we have to require a 12.5% down payment on a VA loan, and that VA loan doesn't get underwritten by us internally. We have to send that loan to, it's in Phoenix, it's a big veterans department in Phoenix. They underwrite the loan because they want to confirm that this veteran and this girlfriend or boyfriend are going to be able to repay this loan, and they want that record on their books, not on ours. The reason for that is just has to do with the veteran's eligibility. That spouse, in essence, is getting a better discount, or they're not spouse, right? Non-borrowing spouse, so it's a girlfriend or boyfriend, is getting the same discount kind of technically the veteran would be getting. And they don't necessarily not want it, but they also don't want to just give that away. So they would require your own investment with a girlfriend or boyfriend.
And just to clarify, and I appreciate that Garrett didn't go too deep because he can geek out. That's their term here,
Yes.
is like geeking out. When we say the VA will pay back that lender, what they really do is they pay the top 25%. So they're guaranteeing that. So, which is greater than 20%. So most lenders will go, yeah, I'm pretty safe with that. I mean, if we have private mortgage insurance, it's only going to go to 20%. So this is 5% better than private mortgage insurance. That's why lenders love it. And that's why a non-spouse borrower would have to come in with 12 they want that much of the skin in the game in those situations, or
half of their investment,
or go visit Marrying Sam and get that taken care of. I knew a guy up in Vista. That's all he did. He did was
marriages.
They'd be lined up down this road.
And we've done that too. So no, like let's
he's
say
also licensed. He can perform the service.
Yeah, by the power vested in me. No, but we can't. We have advised that before, actually, right? If we know, like, because we've been introduced to lots of fiancés before.
Right.
So if we know that their wedding timeline is coming up, right, and we know that they're planning to get married and they really want to buy this home, and they've come to us saying, I want to buy this home, we're going to be like, you got to put 12.5% down, but if you go to the courthouse and just get the marriage certificate right now, you can put 0% down.
Don't tell mom and dad.
Tell mom and dad. Still go through with your wedding, but if you do want to go get 0% down, you can go to the courthouse, get married, and we've had clients do that before to get that 0% option.
But have you ever had a client go?
Yeah, yeah, that'd be a little dangerous. At that point, we'd say counseling.
Yeah, we need counseling, not a loan program.
Yeah.
Okay, so other things about VA loans. We talked about the property. We talked about the borrowers. So back in the old days, we had a maximum eligibility. How big of a loan now can someone get with a VA loan?
That is up to the veteran's qualification now. It used to be that the VA would.
This is huge. This is huge news right here.
This is the coolest part about the VA loan. They guarantee it. So it used to follow the conforming high balance limit, which was, it keeps moving. Right now we're at, in San Diego, 879,000. So typically if this was 2 years ago, we would be allowed to only lend up to 0% down up to $879,000. Now, with the new rule from the VA, if you can qualify for a $2 million house and you can qualify for a $2 million loan, you can receive a $2 million loan from the VA.
Wow.
So, quick example on that, we had a borrower in Coronado. We had two veteran doctors, both used their eligibility to purchase and their incomes. They put literally 0% down, and they have a large loan and a large monthly payment, but they can qualify for it and make that payment.
And that's just crazy. So no money down, 0.5% under the market, if probably a 2% funding fee.
Yep.
But big deal at that point. Big deal.
Yeah.
I mean,
you brought zero in of your own money, your own investment.
2 points for a funding fee. Rock and roll. And by the way, that's not like reach in the pocket funding fee. That's add that funding fee on top of the loan and pay it back over 30 years.
Correct. And if this was a normal loan or a traditional loan, you couldn't do that because it's not government insured. The VA loan will allow you to roll that cost onto the loan program so that you do not have to come out of pocket with it. That's the coolest part about it.
Yeah, it's kind of like well, okay, where do I sign at that point? So real quick, not to go too deep in it, but okay, so let's say a veteran buys a property here, owns it for 3-4 years, gets stationed, now he's going to Camp Lejeune.
Okay.
Can't or doesn't want to sell the property here. Can he buy again with a VA loan in Camp Lejeune?
Absolutely, 100%. So it'll be based off. So the big myth is that you can only buy one VA home and have only one VA loan. That is absolutely wrong. The VA will let you have as many VA loans as you want, up to the certain amount of entitlement and eligibility that you have. So your eligibility right is what do you qualify for based on your standing with the VA. Your entitlement is how much you've already borrowed from that VA. And if, let's say, for example,
give us some round numbers.
Let's say, for example, you have a property here, right? You have a $400,000 loan, a VA loan on a San Diego property. And let's say we are now moving over to, let's just go to Florida, on a base in Florida, right? You want to buy over there in Florida. Housing prices are roughly the equal to same, if not a little bit more. And the limit out there for that high balance limit will determine, because once you have one, that is where the entitlement left that you have is based on that certificate of eligibility. So we'll pull a new certificate of eligibility while you're out there in Florida. We'll see that you've used $400,000 currently and it's on your eligibility form. Well, then we'll have that $400,000. Let's say the limit in Florida is the max high balance of VA allowable is $800,000. Let's just say over in Florida. Well, we know, hey, you've used $400,000. You're allowed to $800,000 in Florida, up to 0% down now. Well, that means you have $400,000, 800 minus this 400. You have $400,000 left of your entitlement. Now you can go buy a $400,000 property at 0% down in Florida. If you wanted to buy, let's say, a $500,000 property, but your loan amount is only allowed to be $400,000 at 0% down, you do not need to bring in the difference of $100,000. There's a calculation allowable by the VA that was 25%. So you would take $500,000 minus the $400,000 that is allowable for you to bring in 0% based on now your entitlement. That's $100,000. 25% of that $100,000 would be your required minimum down payment on this new property in Florida. So that would be $25,000, right? 25% of $100,000, $25,000 on your down payment of a $500,000 property there. So you'd have a $475,000 loan amount, and that'd be VA.
So we're talking about a 5% down payment on a $500,000 house with the seller able to pay for all the closing costs, funding fee added on top of it, credit score of 620 or higher, and then provided that you reach the debt to income, you're in. So,
yep.
So
and you have a 0.5% better than the normal market.
And you have a 0.5% better. So it's a real. It's nice teaching this part of the class. I hate teaching parts of the class where it's like, yeah, but we'll never use that here. VA you're going to use, and now we're going to use them up into, I'd like to say our price range where I work at. Our average sales price is north of $1 million this last year. So it's like, which is great, and it's also great to know that vets, especially our retired vets who have some decent income, can use this now as a tool. Because in the past we always used to go, oh, I want to use my VA. Well, it was so difficult and added expense and so forth. It wasn't competitive. Now a VA loan can be very competitive.
Yeah.
So.
Yeah, and let's say, right, the veteran, if they sold that property, right, in San Diego, mm-hmm. Now they have a full entitlement back.
Right.
Then they're not stuck to that limit, and now they can go up to whatever they qualify for in Florida or wherever they're PCSing to.
And so one other cool thing about VA loans, unlike all the other loans we talked about a lot about alienation clause. Let's say this guy's leaving San Diego and talks to me and says, hey, I want to list my house, and we're going to sell it for $450,000. Let's say there's $50,000. Somebody, if they wanted to, could go, oh my gosh, you bought this at the perfect time. Your interest rate's 2 3/4. I want to take that loan over. They can.
Yep.
Now, the caveat is that continues to burden the veteran because his eligibility is tied up in that house. But there's been lots of times when a veteran says, "I'd rather leave my eligibility and get because I got to get out of Dodge. I got to get over to my new next PCS. It's got to happen, so it makes sense. So
Yep.
it's also one of those things when you're looking to have. Now you can't do this for investors. This has to be an owner occupant taking it over. So me as an investor, I can't go look, though I wish I could.
Yeah.
But someone could buy their first house with a very low down if the amount of that loan is close to the market rate.
Yep.
Provided but you have to qualify and so forth. But you're qualifying at last year's awesome interest rates.
Yeah, 100%. He's talking about it's called a VA assumable loan, and so the VA lets you assume and take on that other person's loan. So if you are a veteran and you're trying to sell that property, the best scenario ever would be if another veteran was trying to come in and buy that property. Well, then the best part is let that veteran assume that loan, because then that entitlement can be transferred over to their eligibility, and then boom, you
substitution.
You freed up that seller's eligibility. But yes, if it's a normal, non-veteran coming in or non-active duty buying the property but wants to do the assumable loan, then they're going to be using that veteran's eligibility until they free it up or sell that property. Cool thing about that process is you do have to meet that minimum gap though. So like Kevin was saying, is it would be really good if you found one where the loan amount was relatively close to the value of the home, because then you're not bringing in that difference in down payment or proceeds that you'd have to bring in to assume that loan. So let's use that simple example again, 400 loan, 500 purchase price. Let's say the client was selling it at 500, their current loan is 400,000. Well, then you're going to have to bring in $100,000 to be able to assume that $400,000 loan. You can't get a loan for that $100,000 and then assume the $400,000 loan. You have to be able to bring in that investment. So that's why Kevin was saying, if you can find one really close to where the loan is right now to that balance, man, would that be a good investment right now?
But if we're talking now 440 or 450, now we're talking like 10% down. I'd rather do a 10% down and take over someone's 2.75% interest rate instead of 6 1/4, correct? Seven.
Seven today.
Oh Lord, I forgot to ask you for the update. Been there and lived through all these. So the interest rate, it's just a number. It's just a number.
Yep.
So
it's your monthly payment that counts.
Exactly. Well, thank you very much, and
we'll hop into the next one.
Good.